tonight using options for consistent returns. My name is Don Kaufman. I will be your host and trader tonight. It's a TheoTrade presentation. A couple things right up front. Risk disclosure. We're not a financial advisor, nor are we a broker-dealer. Although I did spend 15 years in the brokerage world, I have left that behind when we launched TheoTrade. So it's, it's fine to ask, brokerage related questions, but I'm no longer a broker dealer. But you better believe I remember all the regulatory side of the business. Oh, it's exciting. Here's a copyright disclaimer. This is ours. This is not yours. Right? You have to have written consent from the National Football League. Football's coming back. I'm excited. Actually, the real reason I like to throw this up here, if you ever need to get a hold of us, this is our address. Again, we're in Scottsdale, Arizona. It's our phone number. Okay. And of course, email. We like to do something that's unique. We actually answer emails, and we use what we call a general inbox. So it's support@theotrade.com. That gets to any of our support staff. It gets to all of our trading staff, you name it. If you need to get a hold of me after tonight, just go to support@theotrade.com. It's always very important to me that you know that you can reach out to us at a moment's notice, and we'll help you get through whatever it is. This is a little bit about me. Again, my name is Don Kaufman. I started trading in the late 90s, the ripe old age of 22. I had some family, traded in Chicago. They invited me 3 weeks out of college. So I went from a dorm room to flying back and forth to Chicago within literally a 3-week period of time. And a short time after that, about 18 months after I started trading, I was invited by a couple of traders that I knew in the OEX pit. The OEX, the S&P 100, it's rarely traded these days. I was invited into a startup called thinkorswim, and I spent a very large portion of my career at thinkorswim. I was there when we took the company public in 2007. I was there when we were acquired by TD Ameritrade in 2009. And I actually went on to run the entire education division of TD Ameritrade. And at the time, the 7 million clients of TD Ameritrade, I did that roughly until 2015, at which time we finally packed it up and said I had enough of the regulatory side of the business. I used to spend all my time talking to FINRA, talking to the SEC. Nothing bad, but it's just, Dodd-Frank bill came in and it changed everything for us. So that's a little bit about my background, and that's what we did before we launched TheoTrade. So I've got a lot of thinkorswim platform experience, quite a long trading career. And by the way, the entire time I was at thinkorswim, TD Ameritrade, people, we traded. I've done all the CNBC experiences. I like throwing this one up here. It's one of the more notable ones. I mean, if you're going to be pitted against somebody, you want to be pitted against Mr. Wonderful himself. Anyway, this interview, it's pretty memorable because it didn't go the way I thought it was going to go. He started agreeing with me. I was the short, he was the long, and turned around and started agreeing with me. It's not at all the way that I wanted it to go, but it was amusing. About TheoTrade. So let's talk a little bit about TheoTrade and jump into it. We specialize in education for stocks, options, futures. We're founded by professional traders. Okay, trading educators. Each of us have a minimum of 15 years of experience. A couple of us have several decades. And first and foremost, we're here to help you mitigate risks in the market while learning a skill set that can last a lifetime. Now, we've really upped the game at TheoTrade considerably. This is the TheoTrade team. This is the instructor team, not our support team. This is just the instructors. So when I say we've upped our game recently, also one of the most important things that you should know about TheoTrade, this is not like a one-trick kind of pony show. This is not, it's Don Kaufman. No, we have myself. We have Jeff Bierman. Jeff Bierman worked with me for 7 years at TD Ameritrade. Jeff was also a former hedge fund manager before being the chief market technician for TD Ameritrade. He's our analyst and internal trader. Next, we have Matt Williamson. Matt is one of our newest. We call him the new fish. Matt, he's our market neutral premium selling option strategist. If you're a premium seller, it's the guy you want to get into. He's a little bit more advanced. Corey Rosenblum. Corey's actually our resident senior strategist and swing trader. Then we come into Brandon Chapman. Brandon Chapman is also brand new with us. Brandon's actually been on for, this is only his second month. He's a CMT, macroeconomics, technicals, and fundamentals. He's actually into kind of like a fusion of those. I have to tell you, okay, guys, unbelievable in global macro. Unbelievable. Steve Slim Miller. Slim has got more experience than several of us put combined. He's on a 43-year stint in the marketplace. Started at the Chicago Board Options Exchange in 1973 when it was founded. Last, but definitely not least, our intraday strategist, Tony Rago. Just trades NASDAQ futures. He is the one-trick pony over there. He literally trades one product, does it quite successfully. With that, that's the instructor crew. Now, again, 7 full-time instructors here at TheoTrade. What you're going to learn in this presentation this evening, number 1, how to position your portfolio with the right trade logic, okay? And we're going to talk about momentarily what I call principles of building a trade. That you're going to find huge by huge, all right? How to replace stock with defined risk option strategies. I said it right there, options. I said the O word. Is it okay if we talk a little bit, okay? Just a little bit about options tonight? I think most people have come to the realization that you can do some good things, some great things with options in terms of risk mitigation. And that's exactly what we're going to look at. That's all right. By the way, these are not rhetorical questions. Even if you're watching this in a recording, you should be talking to your screen. Makes it more amusing. New ways of looking at and making peace with risks. How to make friends with direction. Expose any directional bias and learn, okay, the one thing that direction must eventually bow to. How to use specific probabilities to better your trading, even without extensive charts, or there's no fancy formulas. And the basic recipe of strategy tonight we're going to discuss called the in-out spread that can help you trade. It's a lot safer, build some confidence. Okay, whether you're a beginner, whether you're experienced, you're going to gain a lot from this. And we're going to start to introduce to you, okay, how to build a trade following a recipe, what I call criteria. So I throw this slide up here a lot, and I want to challenge everybody this evening. And every single time I do one of these, webcasts for an hour, I like to ask this question: are you willing to put forth the effort? Because many of you, listen, we're traders, okay? We didn't build a TheoTrade to go out there and just like, let's charge a couple $1,000s for a class and get a couple people in here. Right? We have a staff that is extraordinarily experienced, okay? But we're constantly, bringing new clientele in here to TheoTrade, and people, they tend to look for like what I kind of call the get rich quick and so forth, or what I call instant coffee, instant tea. And listen, if you want to learn this business, I hope you recognize at this point, this is not going to be red and green flashing arrows and be like, oh, it's going to tell me which direction. Okay, if there's something that's going to, if you believe in some software that's going to pick the direction for you, okay, you need to come to the realization that crap doesn't work. I worked for a $20 billion brokerage firm, ran their education division. If there was something that would make our clients more successful than other clients, don't you think we would have bought that for you? So I challenge you that, are you willing to put forth some effort? Because what you're going to learn tonight is a little demanding. It's not going to be a chart pattern or a trade setup. If you want to learn this business, put forth some effort. It's not instant coffee, instant tea. It's a skill set, okay? It involves trade logic, strategy, probabilities, and trading. And I hope you guys don't take that wrong, but it means a lot to me that okay, that there's not this instant coffee, instant tea, the magic wand of trading. That's not what we're about here. And I hope you guys do respect that. Risk and success. How you handle your risk is directly correlated to your success in the markets. Too much risk, you're going to panic, you're going to close positions continuously at the worst possible time. But hey, at least you're consistent with your panic. Notice it's a Mac. It's always the people with the Mac that are barfing up the positions over here. But I always start with this because it's to get you thinking, though. Control your risk, you can have success. It's risk and success. Control your risk, you can have success. What I've learned. So I spent, again, 15 years in the brokerage industry, and I'll put this as eloquently as I possibly can. I've looked at hundreds of thousands of accounts. We used to study accounts. So I've literally looked at hundreds of thousands of accounts, and I would study different cross sections, and you've seen what works, what doesn't. And what doesn't work just gets repeated over and over again. One of the things we're going to talk about this evening, specifically, what works consistently. That's the bottom line. That's where this stuff comes from, is researching, and going into depth of what works, your own trades, hundreds of thousands of other accounts, watching people trade. And I'm going to start this with what I call theory, trade, and logic. Very often people ask, what is TheoTrade? Like, what does it stand for? This is what it stands for. If you're really interested, it stands for theory, it stands for trade, it stands for logic. That's what the name TheoTrade really means. With that, probabilities are law in the markets. One good trade, okay? One trade, good or bad. It does not define you as a trader. Remember that. Trading goes beyond one trade or one idea. It's about thousands of occurrences. And it's about having the right logic over time. You got to remember this is a lifelong skill, and no one has learned this stuff overnight. Go easy on yourself. But I got to focus right here. Remember this. One trade can never define us. So if one position goes against you, okay, it should never define you as a trader. It shouldn't define you with great losses or great gains. And we're going to come to that here momentarily. Now, here's what we term the principles of building a trade. Trade logic, capital allocation, directional bias. What do those mean to you? Again, they're not rhetorical questions. It's pretty quiet right now. Okay? I know people are just intensely watching. This is when I talk about principles of building a trade. It's your entire approach to the marketplace. How do you approach the marketplace? Well, I approach the marketplace with trade logic. First, what does that even mean? Strategy. For the most part, it kind of means strategy. Then I would look at things called capital allocation. What does that mean? I'm going to show you here. And then directional bias. What's directional bias? Oh, we're going to look at a chart. Let's get to it. So trade logic. Let us place strategy and trade logic first. So the vast majority of people involved in the markets are infatuated with direction. I mean, that's what you can bombard it every day. What do you think the stock is going to do? Oh, what do you think it's going to do? I don't know. Let's turn on a guy that throws a chair and talks about the market all day. But that doesn't, make you money, because you can be right. And a lot of people don't know this. You could be right and still lose money. Anybody ever had that happen to them? Anyone? Come on, people. Admitting it's the first step tonight. All right? We'll make this the 12 step to trading over here. Except initially we only have 3 steps. But think about that for a second. All right? The right strategy coupled with established entry and exit criteria, you don't need to be right in picking a direction of the stock markets, in order to be profitable. Okay? And it kills people because they'll be right, they'll be right, they'll be right, they'll be right, they'll be right. Boom! One loss offsets everything you've done right. Everything you've done right. Sometimes 4 or 5 trades, you'll be right. One loss offsets everything. So what does that eventually mean? It means being right can't be. Think about this for a second. I'm going to back up on the slide because it's so important. Being right, directional bias, can't be the end-all be-all. It's got to be trade logic. Think about that, because do you really think, and I'll go back to this also, do you think billions of dollars are at risk at some trading firm because somebody's like, I think the S&P is going up? Hell no. I worked at a big trading firm. They don't do that. Okay, they're all about trade logic. They're about some kind of quantitative edge in the markets. Next, capital allocation. How and where you allocate capital should be strongly considered as a viable portion of your trading methodology. Capital allocation actually takes precedence over being right in the markets. That bothers people to no end. What I'm saying is how much money you stick in this market or how much money you stick in an individual trade means more than being right directionally. Why? Because I bet you anything, if you're over allocated, you will barf up the position. What do you think the first picture was that I had on there? It was a person puking up a position. I know that doesn't sound like, that's not an eloquent way of putting it, but it's the truth. Over allocators, okay? You know what this means. This is when you panic, you start sweating, you're getting the mouse all gross at your place, and you're like, I gotta get out. So capital allocation takes precedence over being right. Last but not least, it's important, directional bias. I'm not here to be an anti-chartite, okay? I've been called that before, and I rather appreciate it. I'm not into anti-charts, but I do recognize what you think and where you think a stock might go doesn't always mean the markets are going to agree with your sentiments. I'm so bullish, and then we go down. You're like, marketplace. By the way, prayer also doesn't work. It doesn't work in the markets because no matter how long you pray for, somebody's praying on the other side of that one. And being right directionally, it just cannot define us as investors or traders. For you may not be right often enough. Duration over direction. How and where you allocate capital can define not only losses, but it can be the defining factor in your overall success or failure in the markets. So I went back to capital allocation for a second because the war cry has got to be duration over direction. You have to be capable of sustaining trades long enough to be profitable. Yeah, maybe. Anybody? Okay. I can't stress this stuff enough. Now, enough of some of the logic talk. I like to express logic in here because I think it's such an important point. But let's start getting down to trading. You want to be right or do you want to be happy? It's really, I mean, I love that. And, people say that crap to me all the time, happy wife, happy life. I can't apply it to my marriage. But the logic, it works very, very well in trading. Okay. I'll always take the stance. You do not have to be right to make money. Okay. By the way, yes, there's a relationship in here. Do you have to be right? Want to be right and want to be happy. And you want to make some money in this business. You don't necessarily have to be right. That's all I'm getting at. Why, you ask? Because experience in watching order flow for decades, it teaches us invaluable lessons. Okay. There's one thing. There's only about maybe 4 or 5 people in the entire, industry that have ever watched order flow for as many years as I have. When I say order flow, I watched retail order flow. I ran part of a major brokerage firm and I got to watch order flow. That is, I got to watch orders pump in through the pipes in the back end, both thinkorswim and TD Ameritrade, which has we at the time had the largest options order flow in the entire, U.S. markets. But let's ask this question. You ever been stopped out of a trade or bailed out of a position only to see the markets turn around shortly thereafter? Okay. Why? We're going to start talking about some logic in here in terms of actual trades, core strategy and trade logic. Today, I want to introduce you to one real world strategy, something you can use tomorrow. All right. And listen, I don't like to come on here and do a session that, that sounds really good logically, but no, we want to put into context stuff that you could do tomorrow. Now, as I get into this, first, we got to get to risk versus reward. When we first learn about markets, I want to get to some of there's a big fallacy in this business. And when you first start learning about trading and learning about markets, we're often exposed to the ideas, and ideals, if you will, of risk versus reward. And a lot of times it sounds so reasonable. Hey, everything you do, you should risk 1 to be able to make 2. It's a common strategic entrance to the marketplace. All right? It's a common strategic entrance to the marketplace. However, have you ever looked at the probability of success of this idea? Now, this stuff is imperative to give you background on the strategy that I'm going to teach. All right? Let's debunk risk versus reward. All right, we're going to take a very simplistic viewpoint this evening, and I'm going to start you off with an example, and hopefully you guys kind of grasp the example, and then we'll kind of move forward from there. But I want you to think about going out and buying a stock, right? Don't worry about options right now. Let's say we buy a stock. We buy the stock right smack at 30, and then we're going to set a stop order at 29. What does a stop order do? Stop. It stops us out at 29. And we're going to set a target price, of 32. Why? Well, if we're wrong, what are we going to lose? 1. And if we're right, what are we going to make? 2. Prototypical risk 1 to be able to make 2 scenario. Yes? That's that prototypical scenario. Now, this could be a day trade. This could be a trade for a month. This could be a trade for a week. It doesn't matter. Time frame doesn't matter. Because what you're going to learn here momentarily is probabilities in trading transcend whether it's a day, whether it's a month, whether it's a week, whether it's a year. And that's what I want to hammer into you early on is you've got to debunk some of the crap that you've learned. Probabilities in your trading. Now, I want you to think here realistically, okay? What do you think the probability of hitting the stop order is prior to hitting the target price? Okay. What I'm asking is, all right, right now we're at $30. So if you look at this stock and it's at 30 and your stop order is set down here at 29, right? That's the stop. And then your target is up here at 32. Okay. What is more probable, hitting the stop or hitting the target? Anyone? Anyone. Okay. Now let's put zero directional bias into play. Zero directional bias. Okay. Why? Because over time, what you're going to find out is that normal volatility fluctuations, it's not going to matter whether you're right. The bottom line with this example is that the probability of hitting the stop, okay, is drastically higher than hitting the target price. Why? Okay. Well, because it's closer. It's the bottom line. It's closer. And you're like, well, how does that work? Okay. How does it work? Well, it's pretty simple. All you have to do is look at this on a distribution curve. All right. And here we are at $30. What's more likely to happen? Hit 29 or hit 32? The answer is, statistically speaking, you're going to hit 29 well before you're going to hit 32. And if you actually did this trade, let's say you did the same thing 100 times, you totally debunk this idea of, risk one to be able to make two. And you're going to find out real quick. This is why people get torn apart with stop orders. Okay. People, this is like one of the first things they teach you working for a trading firm. Now, options or probabilities. Now, listen, some of you may have never looked at or even traded an options market. However, are you aware that options are based on probabilities? Options, and I'm not here to stress like you need to trade options. Okay, yeah, I'm going to show some option strategies, but that's not what this is about initially. But the options, it can help us in determining the viability and practicality of any given trading strategy. How, you might ask? Well, let's look at what the probabilities are in the aforementioned risk one to be able to make two, okay, trading setup and see if it's viable over the duration. Now, I'm going to go from, I've been softballing you stuff here for the first 25 minutes. Now let's get extreme. All right, probabilities exposed. When I say get extreme, let's get a little bit more real. Follow along very closely. You're looking at a screenshot that I took yesterday, and yesterday, the bucks. It's Starbucks. The bucks. All right. I'm a well caffeinated individual. I like to. I used to trade Starbucks a lot. I don't trade it nearly as much as I used to, but Starbucks was trading right at about $54, right? And if you think about this exact example, let's say you went out and you bought the stock, okay, at 54. You bought the stock at 54. You set a target price here of 56, but you set your stop at 53. What's the probabilities? Well, there's this thing called probability of touching. The probability of touching, okay, 53 is 65%. What's the probability of hitting your target price? 43%. How's that grab you? You know what? Forget about the target price. I just want you to look for a second at the probability of your stop order being hit. The probability of the stop order being hit is 65%. Okay? If you play stops against stock trades, how do you ever intend to make money if you're going to get stopped out 65% of the time? You do realize that you could flip a coin. And if you flipped a coin and you were right, half the time, wrong half the time, it ain't going to make a difference, because the mathematics behind this say that you're going to get stopped out 65% of the time. How's that grab you? Okay? Again, this is where people like, it's not fair. What's not fair? Market maker's got no edge over you here. Okay? People talk about this is not fair. Look at the market maker. All right? This is like a 1 penny or 2 penny wide market. They don't have an edge. But I will tell you what their edge is. They actually understand the logic behind this stuff. That's where I started in the business. I started on the market making side of the business. I only moved over to the retail side because I felt, well, you got something to offer. And I also, making markets, I knew in the late 90s was going away. So risk versus reward. In the aforementioned Starbucks example, the probability of hitting the stop was 65%. The probability of hitting the target price was 43%. The risk one to be able to make two scenario, it's a setup, okay, for a low probability disaster. I'm not saying that you can't make money doing it, because people get like, oh, like I can make money. Yes, maybe. But why would you ever want to do this to yourself? Why would you ever want to set up a trade if somebody told you that you have a 65% chance of losing money? That's what this means. Let's cut all the garbage out, okay? Cut the crap out and read between the lines. This means that whatever the trade setup is, you got a 65% chance of getting stopped out, period. 65% chance then of losing $1. And if somebody told you that prior to this, you'd have been like, I'd never do that trade. Okay? That sounds like just ridiculous. You got to learn to really position your portfolio. And that's what this is about. Position your portfolio with the right trade logic. So let's get down and dirty. How do you position yourself most effectively without exposing yourself to drastic risks and or low probability? All right? Would you be interested in a trading strategy that, number one, overcomes the high probability of being stopped out? We're never going to use a stop order. Okay? So one of the first things that we want to do, strategy, that we do not want to get stopped out. Number two, make sure that we define our risk. I want to know precisely what I can make, precisely what I can lose. Number three, high probability of success. Check. Number four, limit its capital exposure. Capital exposure and defined risk, you would think is one and the same, but it's not. It's a defined risk strategy, but the capital exposure can be limited, okay, by you and your contract size. Oh, and you never need to buy or sell the stock. We're just going to trade around it. We're actually going to use the options. What we want to do is we want to encompass each and every one of those aspects. Now, how do we do it? Enter the in-out spread. And this is the impetus for why we trade certain strategies. Okay? The reason I went through that risk reward and the logic of that is to set the framework of why we would use an in-out spread. In-out spreads are designed to limit exposure, maximize potential, but it's all with minimal movement in the underlying. Like, I don't want to say like, oh, Amazon has to move huge. Amazon could move a few dollars and you can make money on it. It moves a few dollars every day. Yeah, in-out spreads though, they're options trades. And that's one thing, as I said, it's not instant coffee, instant tea. This is, I started with this. We are not going to be following the bouncing ball in charts, okay? But fear not the options. As options and these spreads, they're going to allow us to limit our risks without the use of stop orders while providing considerable upside potential. Guys, ready? Let's get into it. In-out spreads explained. So I'm going to take you through a couple of examples that I'm actually going to write up over here. And one of the first things, normally I just do a fictitious example, but today I have a real example for you. It's on a stock, okay? And the stock happens to be called Microsoft. Anybody aware of it? Yeah, maybe. Maybe you're using a Microsoft product right now. You probably wish you weren't, but you kind of have to. Either that or you're a Mac person. Don't worry. I'm not going to rip on Mac. I got my Mac issued underwear on over here. I got my iPad. I got my Apple Watch. I got my phone. I just can't use an Apple computer. Microsoft this evening was trading right smack at 107. I mean, it was just too good of a setup. So here's Microsoft, and it's trading again right at 107. Now, are we going to buy the stock? No, we are not going to buy the stock. We're actually going to trade options around the stock price. The first example, what I'm going to do is I'm going to teach you an in-out spread. I'm going to go out in this case, and I'm going to do what's called buy, okay, a 106 call. Now, I'm going to buy a 106 call. Now, some of you have no experience whatsoever with options. Okay, none. And you're like, I don't even know what a call option is. Anybody here brand new? No experience? Anybody? Okay, because that's fine. But come on, people, admitting it's the first step. I want to hear if you've got experience or not. It's just a yay or nay. And again, if you're watching this later on, be like, I'm talking to my screen on a recording. That's okay too. You're going to buy a 106 call. What's the 106 call going to cost you? Let's say it cost you exactly $2. Now, by the way, this is a real example. I actually took this from an option chain right before this, and it was just so nice. I cleaned it up. Anyway, 106 call. Let me ask you something. What does a 106 call give you the right to do? Okay, gives you the right to buy the stock. Gives you the right to buy the stock not at 107. Gives you the right to buy the stock at 106. This thing is good for a period of time. Don't worry about time tonight. Time doesn't matter if you know how to use these spreads right. I'm going to say that again. Time doesn't really matter if you know how to use these spreads right. But buying a 106 call, all I want you to get is the notion that if you buy the 106 call, you have the right to buy the stock at 106. Do you want to buy the stock at 106? No, I don't want to buy the stock at 106, but I do have the right to buy the stock at 106, and that's going to cost me $2. What am I paying $2 for? I'm paying $2, okay, for the right to buy the stock at 106. Why? Because the stock could fluctuate higher and or lower in the next, let's say, couple of weeks, right? So I'm buying a 106 call for $2. Now, simultaneously, I'm going to turn around and I'm going to be selling, in this case, a 108 call. I'm going to sell the 108 call. And when you sell something, you collect money. How much am I going to collect in this case? I'm going to collect exactly $1. That's why I did this example, because it laid out so nicely. Now, let's get to something over here, because a lot of people are like, whoa. How can you sell something? I don't ever remember you owning it. Well, if you buy the 106 call, the 106 call gives the right to buy the stock at 106. Okay? Now you're buying yourself a right. When you sell an option, you're selling yourself into an obligation. See, the thing with options is at any point in time, you could be a buyer or a seller. You don't have to own it to sell it. Okay, but you are selling yourself into an obligation. What's your obligation here? You're obligated to sell the stock to somebody at 108. You're like, but Don, I don't even own the stock. No, but you have the right to buy the stock at 106. If you have the right to buy the stock at 106, but somebody has the right to take stock from you at 108, what's the most you can make in this? Okay, what you actually have is buy the 106 call. You've turned around, you're going to sell the 108 call. Now, this is what we call a $2 wide spread. It's $2 wide spread. And the entire $2 wide spread, it's done as one trade. What is the trade price? Well, this little monkey, you paid $2 for. This little monkey, you collected $1. Okay? So net, what are you into this trade for? A $1, what we call debit. Yes, I'm actually paying for the trade. All right, and there's a reason I'm not selling premium. I am most definitively buying premium in this case. People get brainwashed. You should always sell options. Yeah, except not in this marketplace, because volatility is incredibly low. So we're actually buying options because it's going to give us, quite a degree of edge. So this is a $2 wide spread. The most you can possibly make in a $2 wide spread is $2, which we paid $1 up front for. Now, let me ask you something. Stop right here. Don't do anything. What's the most you can possibly lose in here? $1. If the world comes apart and Microsoft is trading at 107, trades all the way down to 50, what can you lose? $1. Did I use a stop order? No. Who needs a stop order when you have $1 at risk? Okay, the spread is your stop order. See, the cool thing about the spread, because some people, it takes a little while to get this, but the cool thing about the spread, the stock kind of trade lower and you're like, oh, I'm going to throw up. Why? Because the stock's now down at 100. But do you get stopped out? No. As long as there's still time left in the trade, your dollar debit, you're toast down here. But what happens if the stock rallies back up? It rallies back up, and the stock goes to 109. What are you? Gold, Jerry, gold. You've made your money and you're out of the spread. The whole thing about a spread like this, it's sustainability. It's sustainability. Okay? What can happen to me? I'm kind of impervious to the downside. But if the market rallies, great. I'll make my money. I'll take off. That's it. I mean, you look at the trade, it's like so easy, but listen, it defines your risk. And you're like, how do you have a high probability on this trade? You want to know how you have a high probability? Because the stock can do anything over the period of, let's say that this trade survives for 1 month. What can the stock do over a month? It can go down, it can go up, it can go up, it can go down. But guess what? To the downside, we never get stopped out. To the upside, we do get out. We get out profitably when we rally. That's how it has a higher probability. Think about it for a second. You don't get stopped out. You get to sustain the trade. So what do you get? You get duration. You just bought yourself duration. Okay? And by the way, when I say time doesn't matter, time doesn't matter. You're going to find out, that you can do a trade for a month and it would cost you the same as if you did the trade for 2 months. It'll cost you the same as if you did the trade for 3 months. The trades cost the same when you start pricing them. Now, to continue on. The in-out spread Starbucks example. Let's go back to Starbucks. Let's continue with our Starbucks example. However, let's use an in-out spread rather than stock and stop orders. Rather than buying the stock at 54, we're going to use a spread trade to limit risks and provide a higher probability, okay, without the use of stops. Ooh, Frappuccino. That doesn't look actually that appetizing. Here is another one. By the way, we're going to do a bunch of these. So if you're like, usually you get the deer in the headlights at this point. You're like, oh, let's do it on Starbucks. Here's Starbucks trading right at 54. Do I own the stock? Absolutely not. I'm going to buy the 53 call. I'm going to sell the 55 call. Now, I wrote this one out. How wide's this spread? $2 wide spread. What's the most you can make on a $2 wide spread? You can't make more than $2, of which you've paid $1 up front. So what are you really doing in this trade? You risk $1 to make $1. Now stop the presses. I'm going to risk one to be able to make one. Risk one to make one. People hate that. They hate it. They look at this, they go, that trade sucks. Okay, maybe, but let me make a couple of points over here. Number one, have you ever taken a really big loss in the marketplace because of one trade? Have you ever taken a really big loss in the marketplace because of one trade? The answer, inevitably, if you've traded, is yes. Okay, by the way, this spread is not at all like an iron condor. It's vastly different. So I'm risking one to be able to make one. People take big losses in the markets. How do you take big losses in the markets? With big risk. In this case, do I have big risk? No. Risk one to be able to make one. So you got to take this right back, okay, to where you started in the business. Even if we were right 50% of the time in a risk one to make one scenario, do you realize after transaction costs and everything, I don't care. Let's say that you flipped a coin in this business to decide whether you were bullish or bearish. Okay. At least if you did this strategy, you would break even. You would break even. If you did 100 of these trades and you were right 50% of the time in a risk one to be able to make one scenario, you would break even. I hope that makes a degree of sense because I hammer that home. But I'm going to actually give you the edge in this trade. You're going out and it's a risk one to make one. So where's the edge? The one that you're actually risking to be able to make one, there's a higher probability of making one than losing one. Why? Because on the loss side, there is no stop order. So the market can actually go down, you don't get stopped out, and then still has the ability to rally back up. It actually provides you a much higher probability, okay, of actually hitting and making one. It actually has to do with what we term the probability of touching. There's no stop. Your risk is defined. The probability of making money on this trade is considerably higher than on the loss. Okay, it's all in the structure. It's all in the logic. Now, here's the real trade. Okay, this was a screenshot that I literally took yesterday. Right, and I took the screenshot yesterday. And the only reason, by the way, I took the screenshot yesterday is because the thing was right at 54.04, and these are the real prices. It was trading for about like $1.70, about 58 cents. You can see this trades for about $1.10 debit, right? Not half bad. That's the maximum risk. I set up the entire trade. This is the option you buy. This is the option you sell. Okay. Now we've already gone through that trade. Let's do another one. Let's get crazy. Let's actually go into X. What's X? Here's another one that I wanted to softball this one because you guys are a little newer to it. Here's U.S. Steel, and U.S. Steel was trading right at $31. Now, I try to pick an underlying that's trading right on the button of like 31 or 54, and I do that because it makes the math easier. But look, here's an option that's trading for 91 cents. Here's an option that's trading for what? 90 cents. Okay, what do? We buy these. What do? We sell these. What are we in the spread for? It's $1 debit. That's the maximum risk. What do you want U.S. Steel to do? Go up. Okay. By the way, somebody was asking, does volatility matter? Nope. Volatility does not matter at all because you're buying one option and selling another option. By the way, speaking of the option you're selling in this case, has a 75% probability of touching there. 75% probability of touching. Okay. That's the profitability leg of the trade. 75% probability. It is high probability. There is no volatility exposure. There is no, there's no gamma. There's no theta. Okay. This is one of the purest strategies. And for those of you that don't speak options, you're like, well, I kind of like it. I kind of like it because I only have $1 at risk, right? This is another strategy, again, that we just keep hammering the same idea on different underlyings. Like you don't have to sit here and start thinking like, well, should I do this or should I do this? What if volatility is high? If volatility is high, I just told you, this strategy offsets most of the volatility exposure. What if volatility is low? Well, right now, volatility is low. This is what you want to be doing. The in-out spread has been my bread and butter for years now. Absolutely years. And for those of you, anybody, okay, that is tuned in to any of the TheoTrade evening videos, at any point, you've seen me use in-out spreads, okay? I just did one today, in the TheoTrade video. And I did one on FXE today. Now, this one happens to be bullish. The previous trade was bullish. The trade before that, the Microsoft, was bullish. Can you do this bearish? Of course you can. Now, I'm getting serious. What do I mean I'm getting serious? I'm getting serious. Now I pulled up Amazon. And the reason I pulled up Amazon, not necessarily because I think this is a good bearish trade. I pulled up Amazon to display to you, people, you have a stock that's trading for $1,900. Do you realize you could do a trade, okay, with what, $2.30 at risk? You could actually do one with like $1.25 at risk, but I thought this was reasonable. If you did one contract of this little monkey, you would have $230 at risk. Now, at this point in the evening, somebody always goes, whoa, what about commissions? What about commissions? Okay, what about commissions? How about if I could actually lower all the commission costs? I did spend 15 years in the brokerage world. We have relationships with all the top brokers now. I used to just have a relationship with TD Ameritrade, of course, because of thinkorswim and, helped in some of the design of that. But we now have relationships with several of the brokerage firms. We are growing. We now have thousands of clients at TheoTrade. All right. Once we broke the, several thousand client mark, all of a sudden, all the brokerage firms started making phone calls to us because they realized this is the way, okay, that they want their clients to trade. Brokerage firms want clients that last. Brokerage firms want clients that make money. They're even willing to give us commission discounts because they want our clients so badly. So I wanted to display this in Amazon because in this trade, listen, it's a bearish trade. I'm not saying that Amazon's going to go down, but I wanted to show you that in a $1,900 product, you can have $230 at risk. Now, of course, somebody already came in and they said, well, what about stock selection? Oh, yeah, we can show that. All right. We can absolutely show that. And that part's actually fairly easy. Okay. It's fairly easy. By the way, if you're a non-US client, we have some ideas for you as well. We tell you exactly where to go. So again, we had the Microsoft trade. It was bullish, right? We looked at a Starbucks trade. It was bullish. We looked at a US Steel trade. Happened to be bullish. Now you're looking at an Amazon trade. It's bearish. Okay. Don't worry so much about direction. And why shouldn't you worry about direction? Because what you're going to find out is that just a normal fluctuation in volatility could be extraordinarily helpful in here. And that direction isn't the end-all be-all. Okay? Now, here are some live in-out trade examples. Now, these are all recent trades. One of the things I like to do is I just mentioned a moment ago that on the evening videos, okay, the evening videos that we do, we talk about in-out spreads, okay, often. Here is a Facebook, okay, trade. This one happened to be done on 7/25, all right? It was July. It was, less than a month ago. And listen, we got in day one, we got out day two. This was actually right before, and this happened to be an earnings-related trade. I don't always trade earnings, but this one happens to be an earnings-related trade. I paid $1.17 for it. Now, granted, Facebook, come on, it's a $215 product. Okay, I did a bearish trade on it, obviously with puts. My $1.17 overnight turned into $2.48. By the way, this is a trade confirmation from thinkorswim. If you've never seen it on thinkorswim, this is the exact date, the exact time that I placed the spreads. Okay, next. Lulu. If you're not familiar with Lulu, it's Lululemon. Now, Lululemon has been, and this is where somebody was asking a moment ago. They were saying, hey, how do you pick direction? Well, I'm going to tell you something about Lulu, okay? Because Lulu torments me. Lulu, if you've never looked at the underlying, has been going like this. Now, everybody loves to look at charts. I'm going to draw you a chart. Lulu's been going like this. A little bit of a back off. A little bit. Guess what? This is a bearish trade. I did a bearish trade in Lulu. I paid 85 cents for it. Okay. The bearish trade paid off. Okay. I closed the trade for $1.53 credit. Not a half bad return for a stock that's been straight up, but I caught one of these little downdrafts. All I needed. I was wrong the entire time I was in this spread. And I gotta show this one because I opened the trade in late June. I didn't close it until July 24th. So you ask, like, well, how long do you have these on? How about I have them on until I'm profitable? How about I have them on, okay, until I get down on my hands and knees and I'm like, oh, I can't take it anymore. And then it worked, okay? Because you have the gift in these trades, and the gift is of duration. Now, not all the trades work out this rosy, right? Here's an Amazon trade. Now, the Amazon trade, this was another earnings one, okay? Take a look at the date. It's the same kind of time frame that I was trading Facebook in. I actually opened it the day before earnings, closed it the day after the earnings. Here, I paid $1.25, okay, and I lost money. I paid $1.25. I got out of it for a 33-cent credit. Oh, I took a loss. It does happen. Okay. If you ever look at somebody's screen, they're like, you got to look at winners. You got to look at losers. There's a lot to learn from losing trades. Okay. Continuing on over here. Let's actually look at the Qs. Why trade individual stocks? You know, there's certain times where I personally don't love earnings, although I just showed you a couple earnings trades. I don't love earnings. I like trading index products. I love the Qs. I love the SPY. Okay. I like right now XRT, which is the retailers. I like XLE, which is what? Energy. I love the XLF, okay, which is what? Financials. I mean, I could spend my life in a couple of ETF products. I really do. I really also like XLY, which is discretionary retail. But the Qs, here's a trade I paid 70 cents for. I got out for $1.33 credit. And how long was this trade? It's 5 days. And if you've noticed, I picked a spectrum of trades. And by the way, some people are like, oh, a lot of the trades are June and July trades. Yeah, no kidding. You know why? Because I've got most of the August trades still on. It's not towards, we're getting towards the end of the month over here, but yeah, I've got a lot of August trades still on. And again, if you look at the time frame of the trades, I wanted to make sure everything that I did in here was recent. There's July, okay? There's what? June, July. Here's what? Late July. Here's what? June. Okay, last but not least, let's throw Netflix in here. I love looking at Netflix too. I'm hooked on the juice. Here's a Netflix spread. Opened it in June, closed it in June. 250 debit, 372 credit. Not a half bad return, okay, for a 5-day window on a trade. Never having more than $2.50, okay, at risk. Times however many contracts. And I want to make something clear in here. You go out, you do one contract, you got $250 at risk. You could have a $2,000 account and pull this trade off all day long. But when you're ready to size up, I don't know, maybe do 10 contracts. Then you have $2,500 at risk. I mean, these trades can be sized very, very easily. And that's important. Again, all the spreads that I'm showing you here, it's not just about profit and loss, it's about the right structure. It's about giving yourself the opportunity to be able to make money. Here's some of the characteristics of in-out spreads. The attributes of the high probability, it's a high probability in-out spread, are undeniable. You never have to buy the stock. You define your risk. The risk is limited to precisely your comfort level. You don't need a stop order. Okay? You can vary time frames and not pay more. We didn't even get to that. Like, what? Could I do a month? Could I do 2 months? That's what criteria is. The probability of profitability is high. This is the perfect spread to reduce risk of a stock portfolio. Speaking of which, there's no stock traded. Okay? It can also be done in a tax-deferred account. If you have an IRA, I'm actually trading these days in an IRA. Right? I trade in there. It's an excellent tool also for those, if you want to build a smaller account, there's not a better strategy than the in-out spreads because it's consistency. Now, building the in-out spread. Building an in-out spread, do not let options intimidate you. The spread below is being done, okay, for a minimal debit. But the spread is also akin to just a massive chainsaw. By the way, I put the spread in here for Amazon at 230 debit, but whether you have a dollar, I was looking at the Starbucks trade, whether you have a dollar debit, whether you have a 230 debit, neither here nor there. But you got to realize when you're doing a trade like this, okay, when you're doing a trade like this, you have to get the options right. The whole key is the selection. It's the criteria, okay? Used correctly, this can be the quickest, the fastest, the safest way, an effective way to create returns. Used incorrectly, you're going to cut off a few fingers. And I always give the analogy, if you were going out there and you wanted to build a house, would you use a handsaw or would you probably use a table saw? Of course, you're going to use the table saw, but if you don't know how to use the table saw, it's bye-bye, your entire hand, or bye-bye a couple of fingers. And these spreads, they're the same thing. I absolutely, okay, every one of you can learn how to do these types of spreads. So fear not the in-out spread. If you don't know options or you have limited options experience, okay, we can show you how and when to place the trades. It's a matter of a few hours. What we do here at TheoTrade, it's not just give you a strategy and let you loose. We develop definitive recipes. We develop criteria. And you wouldn't bake a cake without a recipe, so why trade without one? And that's not a rhetorical question. That is definitive. If you were going to bake a cake and you've done it 15 or 20 times, sure, you could probably do it without a recipe. But why would somebody assume that they can trade without some type of recipe behind them? I don't understand that. If you're going to take off in a plane, I hope that your pilot has done his checklist, before he or she takes that plane up in the air. They walk around the plane, okay? They're pulling on the engines over there. It's the same crap in trading. You got to have a recipe. That's what criteria is all about. This is kind of what our members are saying. The in-out spreads have been very helpful, as I've been able to get on a hot streak and double my small account in 4 months via the use of in-out spreads. Using these in-out spreads on momentum trades is very helpful, and I have such a clearly defined profit target. I don't have to worry about the market noise as much. Okay, it also seems to give up far less slippage. That's a bid offer spread. All right, when instead of going out and buying calls or puts. Okay, and this is one of the reasons that we do this stuff. And people always ask this too. Why doesn't everybody do this? Because you need to know something. All right, you need to know. Hey, what stocks do I do this on? How do I determine whether I'm bullish or bearish? What expiration do I select? What strikes do I use? Position sizing. What's the correct probability? How do I execute the trade? Execute means send, right? When do I exit? What do I do with a losing position? Oh my! Okay? This is what we do here at TheoTrade. We will give you every strategy you ever want. But what we really do, it's criteria. It's criteria. It's recipes. Trading is all about answering the what ifs. What might be a good stock or ETF candidate for an in-out spread? We'll give you that. What's the correct options expiration cycle to buy my in-out spread? How much capital do I commit to these trades? What options do I buy? What options do I sell? How many? What strike price options do I buy? It just never stops, right? We have the answer to all the questions. We'll give you the right probability. How many option contracts? All right, when do I close it? What if the stock sells off big? What's the correct return for the strategy? What if we rally massively? Can I fix it? Okay, we have the answer. We have the answer to all the trade-related questions. All we do is just build a recipe with definitive criteria. It's just a checklist. Each strategy, okay, and each unique variable that you're going to encounter. Each unique variable. Think about this. The how, the when, the why, at what price. It is just the beginning of the many variables you're going to face, okay, while buying an in-out spread. Do not let this intimidate you, okay? If we took you through the variables and we said, step 1, do this, step 2, do this, it will literally lead you, okay, by the hand into this. The secret, though, it's always in the sauce. And everybody thinks when they see this, hey, you could read about these spreads. Well, think again. The strategy you could read about. Anybody could figure out the strategy, but it's the corresponding criteria that requires the utmost attention to detail. And we spent years fine-tuning this. A lot of the criteria, okay, that we go through, a lot of this comes from looking at tens of thousands of accounts. When we approach an in-out spread, you follow the steps to be able to build a trade. If you want the criteria to build an in-out spread, this is what the course curriculum looks like. Imagine that. We have a course. Of course we have a course. Okay? We've got a course for this. This is the curriculum. And bear with me here for a minute because I'm going to show you some very, very cool things here momentarily. All right? By the way, do you use fixed stocks? Do we have a scanner? Actually, the class has a scan in it. All right? What's the maximum you're going to pay? We show precisely that. That's precisely the recipe. What's the max you're going to pay? How do I determine the strikes to use? Done. We talk about that. What if Amazon drops to X? Am I going to be assigned? Absolutely not. We talk about that as well. Like, it's great because you guys are hitting right upon the correct questions. What we actually do in the course curriculum. And I'm going to show you something very cool. So bear with me for a minute. Obviously, you're going to learn how to construct the trade. But you're going to learn for consistency. You're going to learn, okay, to buy long duration options without paying more, okay? Because we're going to give you the gift of time. You're going to find out that the in-out spread offsets time, okay? How to use defined risk reward strategies so you don't have to lose sleep. In-out spreads, okay? You can use really in any market condition. Directional bias would be secondary, but we do have directional setups. We're actually going to take you through how to build your own in-out spread with detailed step-by-step entry and exit criteria. We're going to teach you also how to use this with what we term GTC orders. That's set and forget. You know what that means? GTC, it means good till canceled. You will not have to watch the trade all day. You put the thing on. And you know what? Even if you work during the course of the day, doesn't matter. In-out spreads, there is no reason that anybody, anywhere can't place these trades. Forget about even on a mobile. You can do this on a mobile application. You don't even have to. You can actually route these trades in the evening. They're that easy. Okay? Easy to do, easy to learn, easy to place. You could do this with an account, $2,000. Okay? You do have to have $2,000 in the account to be able to do this. And you could do this in retirement accounts. Minimal options experience, smaller accounts. But you know what? I don't want to water this strategy down at all. And you know, when I say I don't want to water it down, I'm like, if you have a small account, like I get it, it's set and forget, and you could do this, while you're at work. But at the same time, I use it in my, the one IRA that I trade every single day. I've got about $300,000 in that one IRA. I trade it. I trade some size under these too. I don't care if you have $1 million or $3 million in this account. You can trade this strategy. So again, I don't want to feel like it's watered down. This is the curriculum for the class. It's everything you need to know about it. Now, the class is a high probability in-out spread course. I'm the trade instructor. It's a 3-hour course. It's available immediately with 24/7 access. By the way, this is a very recent recording of the class. We like to archive it. We archived it. The class slide deck that includes entry and exit criteria. That's the checklist. It is available immediately for download. The class also qualifies you for a reduced commissions rate. The class is $199. However, we have a little bit of a deal for you this evening. Okay? People love a little bit of a deal. We're going to show you something quite entertaining on this front. And many of you may or may not be aware that here at TheoTrade, we've changed everything. Again, the high probability course you will absolutely love. But bear with me for a moment as I take you through this, because everybody thinks to themselves with these courses, it's another $199 I have to fork over. And you think to yourself, yeah, you've been there, you've done that. Many of you tuning in tonight, you've been through the gauntlet, paid classes, indicators, what I call secret squirrel black boxes, maybe even more. Okay? And everything you go to, they go, only to find out, just buy this one last thing. Oh, we have a new indicator. It's for sale. This one is the golden ticket. It's the holy grail indicator. But wait, there's more. Constantly selling you crap for thousands of dollars. We at TheoTrade, listen, we've had enough of the educational garbage, the educational sales pitches, and we're going to put an end to it. Okay? And we've really changed the entire structure of what we do. We want to disrupt financial education. We're built by professional traders. Everybody here has a minimum of 15 years of experience. We're not professional salespeople. Okay? But we feel very strongly about what we're doing here. Educating you is our only goal. And we're going to demonstrate that. I put, a little proof is in the pudding, right? I'm not going to charge you $1,000 for something that you don't even know what it is. I'm not going to charge you $200 for something you don't know what it is. We want to change the way that you view education. And we're introducing what we call Total Theo Unlimited Streaming Monthly Membership. We are the Netflix of trading. We are the Netflix of trading. What do you do at Netflix? You pay one fee for the month, unlimited access to everything that Netflix has. Well, guess what? Check this out. This is what Total Theo Unlimited Streaming is about. It's $99 a month. Okay? Now listen carefully. You don't have to pay the $99 a month. You could buy the class. You could buy the class for $199. But for $99 a month, we will include the high probability in-out spreads course. It's included in the unlimited monthly streaming membership. It also includes access to 70 trading classes. Now, that is a little bit overwhelming. It includes everything. You're like, what's everything? Everything. We have 3 years of archives in here. 3 years of archives. And every month, we come out with new classes. Every single month, we're just cranking more classes. What do you think? Okay? We have 7 full-time instructors. We just keep rotating them in. You know, we actually had a class on Tuesday. It was with Jeff Bierman. Spectacular. It was about trade triggers for those of you that are in technical analysis. Okay? Classes coming up constantly. But forget about just the archive classes, which I'll show you in a minute. We also have a live trading chat room. Now, not everybody can tune in all day, but all of this is archived. We now broadcast 6 hours per day. When do we start? Okay? 8:30 a.m. Central Time. When do we close? 3 p.m. For the most part, we broadcast throughout the course of the trading day. We take about a half hour off. Indicators. We now have 59 proprietary indicators. You're like, what's an indicator? We have proprietary studies and scans. In fact, you know, you're signing up for this high probability in-out spreads course. It has scans associated with it. By the way, we also email out trade ideas. We have coaching sessions. You know, the 6 hours of live trading a day, we actually break it up. We have an hour of live trading, then we have a coaching session, timely topics, stocks, options, futures. And our instructors, they will directly answer your trading questions via email. They will directly answer them in the chat room. Okay, I will show you all of this. All you have to do is go to TheoTrade.com/all. Okay, it's $99 a month. By the way, at $99 a month, you tell me how you're going to go wrong. How are you going to go wrong in that one? And I'm going to answer all the questions here momentarily that come up. But before I do so, before I get into some of the detailed questions, okay, just recognize we're giving you $100. I strongly suggest you take the money. And what am I saying by that? You can sign up for the high probability in-out spreads course. We will charge you $199, just a one-time fee. You get the high probability in-out spreads course. Or you can sign up for unlimited streaming. It's $99 a month. It includes the high probability in-out spreads course. You know, you're like, well, why would you do that? I'll tell you why we do this. Okay? It's worth the $100 risk to us. It's worth it because we know that once you actually check out what we offer, you're going to realize, especially if you've been anywhere else or you've even watched other webcasts and so forth, you're going to know at $99 a month, there is nothing at any price. I don't care if somebody charges $25,000 for a year of education. By the way, I used to run a firm that charged $25,000 for an 18-month class. It was disgusting. It was ridiculous. Okay? We shut it down. Literally, we shut the company down. I was at thinkorswim. It was TD Ameritrade. It was owned by them. Shut the whole thing down. Okay? This is what I always had in mind for education. $99 a month. It's better than a $25,000 class. Hands down. Why? Because I put together a lot of the curriculum for the $25,000 class. Okay? We give you everything. Over 70 classes, new monthly classes, daily live trading room. We give you trade ideas. Everything's archived 24/7. You can stream it. We're even adding mobile applications right now. There's going to be a mobile app, so you're like, oh, cool, I can watch the archives on my mobile app. All the indicators, the daily coaching sessions, it is all part of it, okay? It is all part of what we call Total Theo, like unlimited streaming. And I cannot stress to you enough. Now, I know there's a lot of questions that are coming up, okay? What our members are saying. Just finished my very first quarterly trading report and grossed over 21%. Doesn't sound like a lot, but that's damn good. Okay, thanks, TheoTrade. I'm up $4,000 this week. All right, I'll let you know how much we appreciate all you guys do. This is the web address you want to go to, theotrade.com/all. Now, let me show you a little bit about our site. Before we go any further, I'm going to show you a little bit more about the site itself. Like this is what TheoTrade looks like. This is the class archive. Okay, and when I say the class archive, again, this is where you actually will go and you can take a look at all the different classes that we happen to offer here at TheoTrade. I'll kind of scroll down, right? This is option strategy classes, option newbie classes, technical analysis. If you're into day trading, trend trading, hedging strategies, that's reduction of risk. Futures classes, stocks classes, okay? Pairs trading. How about we actually have an entire psychology area? You know, one of the psychology classes we have in here, that alone, okay, is a few $1,000 class. We offered it for a few $1,000. Okay, we literally offered a class, okay, and now everything's included for $99. Okay, watch all you want. And it's a membership, and I'm going to answer those questions. Okay. Somebody said, do you have a class on writing a trading plan? Of course. It's trading plan classes. What are you thinking? It's a trading plan right in here. Okay. So what do? We click on the archive. Okay. We look down. What do we got? Planner gets slaughtered. Right? Top 10 skills for growing a small account and 5 essential building blocks to successful trading. But planner gets slaughtered. That's the one where you actually plan out and build an entire trading plan for it. I mean, it just goes on and on. If you're interested in options, listen, I happen to be the option geek here. So I lean towards the option side of things. Here's my beast. Everything from iron condors to the risk twist spread, okay, to the guide of high probability spreads, selling high probability spreads, weekly diagonals, butterfly classes, okay. Here's the in-out spreads, 2018 edition. That's the class that, I was presenting to tonight. But I want you to understand, you get all these classes. That we don't have those types of limitations. By the way, if you're brand new to this, we'll give you a bit of a walkthrough. Like you're like, I don't know where to start. We even have a searchable index. You can type in anything you want in here. Okay? Type in like vertical spreads. You can search, okay, through TheoTrade. Everything involving vertical spreads would of course populate in here. Everything. Right? It's all in here. It's different coaching sessions. Now, shared charts, scan studies. As I said, there's 59 shared indicators in here. Actually, there's probably a lot more than that right now. There's Tony, there's Jeff Bierman, there's Matt now has some. It just goes on and on. Here's all the shared indicators. Okay? Want them? You got them. We don't charge $1,000. Okay? It just goes, as I said, on, and you will absolutely love the Start Here section. Somebody here is like brand new. You're like, I'm a little overwhelmed by this. Where do I start? How about you start where it says Start Here? It'll actually take you through all the basics to get you prepared for the in-out spreads course. Now let me answer a couple of questions. By the way, this is the site that you want to go to. Let me throw up the address one more time. Also, you can email us, support@theotrade.com. You can also call us, 800-256-8876. We're also here to be able to answer questions. You can come in here. All right? That's my baby! That's one of mine. It's the iPood shirt. Anyway, I have a lot of those. Children, that is. Here's the total Theo. Unlimited monthly streaming. It's $99. It includes, of course, the high probability in-out spread. But I want you to know, everything else is included in here too. We don't hold anything back. Okay? Again, we want to be known as the Netflix of the trading world. It's theotrade.com/ALL. Again, theotrade.com/ALL. Let me answer a few questions as we kind of go along, because there's always a lot of them. The first one, and I see it already in here, okay, is, by the way, somebody was asking about the discounted commission rate. I'm going to get to that momentarily. Again, bear with me for a moment because, pay attention to some of the details. I think you'll really like this. The first thing, is this a membership for $99 a month? Can I cancel at any time? Of course. Yeah, you can cancel at any time. In fact, we don't want to bill you unless you're comfortable with being billed. So we'll actually even email you and remind you, because we don't want Netflix doesn't do that. Netflix is just like $15 a month. Okay. Whatever other service, $100 a month. We'll even email you. We want to make sure that you want to be on here. We want you to maximize this. You realize at $99 a month. Okay. We'll save you more than that in the first day. You listen to one class, you're going to be like, oh, that was easily worth $1,000. okay, you're going to get beyond your money's worth. I cannot stress that enough. Like if you're looking at $99, like, it's another charge every month. Yeah, it's a charge that you need if you're going to be involved in this business. Okay, there's a class in here called Trade Execution. That class, okay, you watch that class. If you trade the Trade Execution class, it'll save you more than $1,000 the first year. Okay, I'll put money on it. Check it out. It's the Trade Execution class. I cannot stress this enough. The next thing, okay, discounted commissions. The discounted commissions. We have discounted commissions. Probably the best deal we have going right now is currently through TD Ameritrade. Now, if you're interested in what that discount happens to be, you must, okay, chat in. I cannot mention the discount on any live broadcast. So you have to chat into us right now, okay, and say, hey, what's the discount with TD Ameritrade? If you have an account with TD Ameritrade, they will still give you the discount. So even accounts that you've had for years, if you do not have an account with TD Ameritrade, we will give you a link to open an account, and that account will have a discounted rate associated with it. So we will come in here and we will gladly answer those questions. You know, what's the discount? What's the discount? What's the discount? Okay. And again, we'll have JP, John is in here answering questions. Jeff is in here answering questions, a bunch of the support, and we will help you out. By the way, if you're a Canadian client, that's something I can email you with on the side, because Canada, little bit more tricky. Now, remember, it's a membership, but you can cancel at any time. But we believe in what we're doing here, and we think you guys are going to enjoy it and probably not going to cancel like right off the bat over there. We hope you're with us for a lifetime. Everything that I do here at TheoTrade, you can do predominantly in an IRA. That's not true of all the instructors, but almost anything can be done inside of a tax-deferred account. Another thing that comes up, people always say, I cannot get approved for options because I'm new. We will help you get approved for options even if you're new. It is not a problem whatsoever. Okay, it is not a problem whatsoever. So just be aware that, again, and I'm feverishly copying and pasting into here. So, or copy and pasting into here. Anyway, again, we cannot mention this in a public forum. So it is just easier to kind of type in over here what the discount happens to effectively be. All right. And lots of questions coming in on that one. All right. Let me, by the way, you do have to be a member of TheoTrade. Even if you're a member for a month, they still give you the discount. Okay. It's, you know, it's very clean like deal that they've kind of set up for us. All right. The next thing is, people always say, I cannot make these classes live during the day. If you can't make the classes live during the day, that's fine. Actually, most of our really big classes, the big classes happen to occur, okay, on a Saturday. But if it's not, right, it's okay. Right? It's okay that, you know, if you can't make the class live, everything we do happens to be effectively archived. And again, it is good. So I'm just popping these in here like crazy. By the way, if you're waiting for an answer on the commission discount, I will get in here. Okay, and I will answer all of them. By the way, there's a lot of great questions firing in over here. So everything we do is recorded. In fact, you'll find everything under the archives in there. Another question came in and said, well, I can't get my head around, you know, wrapped around options. You know, will I be able to follow along with the in-outs class? Yeah, absolutely. And you know what, if you're really, really new to options, might I suggest, hey, spend some time, as I mentioned, in that Start Here menu. Spend some time in kind of the Start Here menu. That's right under here. As you log into TheoTrade, you go to Start Here. The other thing is, hey, tomorrow, you know, you sign up this evening, tomorrow, this is the live chat room. You can see we're off air currently, but take a look down. We just had a chat. We do a Wednesday night chat, and you can see there's, you know, hundreds of people in the chat room live right now, and they're still talking back and forth. Nevertheless, this is what the chat room is, and you just go under Member Chat Room. You could join us tomorrow. Like literally tomorrow, hop in there. You're going to feel, though, like a little lost initially. It's okay. We'll get you guys ramped up in here. So if you don't have that much time, you're working full time, don't worry. You can do this. We have a lot of strategies and a lot of emails that go out about strategies that are much more Okay, hands off. All right, so I got to stress that to you again. The strategies themselves are extremely hands off. However, during the trading session, we do get a little bit more intense with some intraday discussions. With that, I'm going to try to answer, okay? I'm going to try to answer many more of the questions that have fired in tonight. I do hope you'll join us here at TheoTrade. It's theotrade.com/all. Again, I stress to you, if you're worried about, getting your money's worth out of it for $99, okay, you're going to find out real quick there is nothing comparable at any price in this industry. I want to thank you guys very much for joining us tonight. Again, my name is Don Kaufman. Hit us anytime. Support@theotrade.com. Thanks, everybody.